Ever wondered how companies recognize revenue from customer contracts? Welcome to the world of IFRS 15, an accounting standard that provides a comprehensive framework for this very purpose. Adopted by the International Accounting Standards Board, IFRS 15 is applicable across all industries, replacing the previous revenue recognition guidance. At its core, IFRS 15 is built around a five-step model. Firstly, it requires the identification of a contract, which exists when there's an agreement between parties with commercial substance. Secondly, it involves identifying the performance obligations, which are the promises to deliver distinct goods or services to the customer. Then, the transaction price is determined, which is the amount the entity expects to receive for transferring these goods or services. The fourth step is to allocate this transaction price to each performance obligation. Finally, revenue is recognized when the entity fulfills a performance obligation by transferring a promised good or service to the customer. Today, we will delve into the five-step model of IFRS 15. First, we identify the contract. Now you might be wondering, what exactly is a contract? Let's dive into that. A contract is essentially an agreement between parties that carries both commercial substance and mutual approval. It's not just a handshake or a casual conversation, it's a legally binding commitment that outlines the terms of a transaction. Think of it as a roadmap that details who gets what and when. But it's not just about the agreement itself. A crucial part of identifying the contract is pinpointing the rights regarding the goods or services to be transferred. This means understanding what each party stands to gain from the contract. Is it a shipment of goods, a delivery of services, or perhaps a combination of both? Understanding these elements is vital because they form the basis of how revenue will be recognized. So, there you have it. Once the contract is identified, we move to the next step. Next, we identify the performance obligations. But what exactly does this mean? Simply put, performance obligations are the promises we make to our customers to deliver distinct goods or services. These commitments form the very backbone of our contracts. Now let's delve a little deeper into the concept of distinct. A good or a service is considered distinct if the customer can benefit from it either on its own or coupled with other readily available resources. This means that the product or service must have value to the customer independently or when used in conjunction with something the customer already has. Let's consider an example. Suppose you're a software company that sells a package comprising an operating system, a word processor, and a spreadsheet program. Each of these components, while part of a single package, can be used independently, and thus, each constitutes a distinct performance obligation. On the other hand, if you're in the business of building custom yachts, your performance obligation is not distinct. Each step in the construction process, from designing the hull to installing the navigation systems, doesn't have standalone value to the customer. Instead, the entire process is a single performance obligation because the customer can only benefit from the final product, a fully constructed yacht. But identifying performance obligations isn't always as clear-cut. For instance, a company selling a smartphone with a 1-year warranty may have two performance obligations, one for the phone and another for the warranty service. If the warranty provides a service beyond the assurance that the phone complies with agreed-upon specifications. It's important to note that performance obligations don't just cover physical goods. They can also include services, licenses, rights to use assets, and more. In summary, identifying performance obligations is an essential step in revenue recognition under IFRS 15. By clearly defining what we've promised to our customers, we can better understand how and when to recognize revenue. Once performance obligations are identified, we determine the transaction price. Now we determine the transaction price. This is a crucial step in the IFRS 15 revenue recognition model. The transaction price is the total amount of consideration that an entity expects to be entitled to in exchange for transferring goods or services to a customer. It's not just about the sticker price on a product, it's about the overall value that the entity expects to receive. To calculate the transaction price, we need to consider various factors. One of these is variable consideration. This is an amount that can change depending on the outcome of future events. For instance, if a company sells a product with a sales-based royalty, the transaction price cannot be fully determined until the final sales are known. Another factor we must consider is the presence of any significant financing components. If there's a significant timing difference between when the entity delivers a good or service and when the customer pays for it, we need to adjust the transaction price for the time value of money. For instance, if a company sells a product today but doesn't expect to receive payment for a year, the transaction price should be discounted to reflect the present value of that future payment. Discounts can also affect the transaction price. If a customer is given a discount for buying a large quantity of goods or for being a long-term customer, this needs to be factored into the transaction price. It's important to note that the transaction price should reflect the amount of consideration to which the entity expects to be entitled. This means it should not include amounts collected on behalf of third parties, for example, sales taxes. Also, the transaction price should be adjusted for the effects of non-cash consideration and consideration payable to the customer. For instance, if a customer provides a good or service as consideration, or if the entity pays the customer for an activity that doesn't represent a distinct good or service, these should be factored into the transaction price. The process of determining the transaction price can be complex, involving careful judgment and potentially sophisticated financial modeling. But it's a vital step in accurately recognizing revenue under IFRS 15. After determining the transaction price, we allocate it to each performance obligation. Now, let's allocate the transaction price. We've identified our contract, we've determined our performance obligations, and we've calculated our transaction price. So, what's next? Well, we're now at the stage where we need to allocate that transaction price to each distinct performance obligation in our contract. Think of it like this. We've got a pie, and that pie is our transaction price. Each slice of that pie represents a performance obligation. We need to ensure that each slice or performance obligation gets its fair share of the pie or transaction price. Now, how do we determine the size of each slice? Well, that's where standalone selling prices come into play. The standalone selling price is the price at which an entity would sell a promised good or service separately to a customer. So, we allocate the transaction price based on these standalone selling prices. But what if we can't directly observe the standalone selling price? Maybe we've never sold this good or service separately, or perhaps market conditions have changed. Well, in that case, we have to estimate it. Estimating can be a complex process. We might use cost-plus margin approach, or a market assessment approach, or even a residual approach. It all depends on the specific circumstances. But the key is to use a method that best predicts what the standalone selling price would be. Remember, this allocation must be done at the inception of the contract and shouldn't change unless the contract itself changes. This is important because it ensures that revenue is recognized in a manner that best reflects the transfer of goods or services to the customer. So, to summarize, allocating the transaction price is all about ensuring that each performance obligation gets its fair share of the transaction price, based on its standalone selling price. It's about making sure that the revenue we recognize accurately represents the goods or services we're providing. And that's it. We've allocated our transaction price. The next step? Well, that's where the fun really begins. Once the transaction price is allocated, we recognize the revenue. Finally, we recognize the revenue. This becomes possible when, or as, the entity satisfies a performance obligation, essentially by transferring a promised good or service to the customer. The question of when is critical here. Let's break it down. If the customer simultaneously receives and consumes the benefits provided by the entity's performance, the entity recognizes revenue over time. For example, a cleaning service may recognize revenue over the duration of the contract. On the other hand, if the customer doesn't simultaneously receive and consume the benefits, the entity recognizes revenue at a point in time. For instance, a car manufacturer may recognize revenue when the vehicle is delivered to the dealership. It's all about understanding the nature of the performance obligation and when the customer obtains control of the promised goods or services. And that completes our 5-step model of IFRS 15. Let's summarize what we've discussed. We delved into the intricacies of IFRS 15, an essential accounting standard that provides a comprehensive framework for recognizing revenue from customer contracts. We explored its core principle, a 5-step model that includes identifying the contract and performance obligations, determining and allocating the transaction price, and finally, recognizing the revenue. We also touched on other considerations like contract modifications, customer options, and warranties. Not to forget, we highlighted the importance of enhanced disclosure requirements and the effective date of this standard. It's crucial to grasp and implement IFRS 15, as it bolsters comparability across industries and regions, offering more relevant and useful information to financial statement users. Remember, it underscores the importance of reflecting the transfer of control to the customer as the key criterion for revenue recognition. For complex scenarios and transitions, don't shy away from seeking professional advice. Thank you for joining us today. Don't forget to like and subscribe to our channel, Corporate Canvas, for more insightful content.